what typically would happen if it's a husband and wife that owns the house. Let's say only one of the persons are on the house title or the deed, or they only got the loan off of one individual. The spouse and kids live there. How's the housing situation when the primary passes away?
Then the bank owns it again, right?
Right.
So the thing is, if you're going through the bank or the mortgage company, and then you get some insurance through there, the thing is, they're not looking to protect the client to make sure that they still have a home to live in after the fact. They're insuring the life of the client to make sure that they get their money back.
So we're going to go get started. All right. So welcome to the Agent Q&A. You got your host here, John. You got Joanne.
Hi, everyone.
You got Albert. So for anybody that has any questions, go ahead, Ray, Kuhn, if you guys have any questions. If not, we'll go into our topics. Topic today, it's going to be more into the leads, mortgage protection specifically. We can start from the beginning. We'll just start off. What is the mortgage protection? Care to answer?
Yeah, well, I think a lot of times people confuse this whole, they're like, what's a mortgage protection product or what's a mortgage protection type of lead? So it's actually just a concept.
Right.
So it's not like this is a mortgage protection product. It's more, mortgage protection is more like, all right, client, we're identifying the need for the client. They just took out a mortgage or they have an existing mortgage. So the thing is, we just want to be able to make sure we're able to protect them in case they were to pass away, that their family is able to either pay off the home or have enough of a cushion where they're able to maintain the mortgage for them to decide what they're going to do with the home.
So we also get confusion on when client says, I got mortgage protection through my loan. Right. What is that? So
a lot of times when people take out a loan, depending on the mortgage company, sometimes they require them to get some insurance.
Right.
This is in case they die. So then, they protect their back end, but then that money goes to the mortgage company.
Yeah. So that's the PMI.
Yeah.
Right. So PMI versus a mortgage protection life insurance.
Yeah.
Right. So what we try to offer is we protect a mortgage protection life insurance on the client in case the client dies. There's enough money from the life insurance to either pay off the mortgage balance or take care of the payments until the family transitions into doing whatever with the house, whether they want to move in, they want to sell it, or they want to go and take out the equity line or rent it out, do whatever they want.
One more common misconception when it comes to mortgage protection, just I can thoroughly confuse all of you.
Yeah.
There's also sometimes the bank offers some insurance, say this will cover you, to pay off the mortgage or to protect you in case someone passes away. Typically, that's often just a accidental death insurance, and so it's not going to cover you for a natural cause. It's also relatively cheap, but there's a lot of fine print and asterisks behind that. So something to really take note of when a client says, "Hey, I think I already got something through the bank." Mm-hmm. And then just ask them how much it is. They're like, I don't know, like $20, $30. That's
$20
almost for sure an accidental death coverage.
Yeah. They'll tell you they got it through the bank. They got it through their credit union. Oh, it's included into their plans. Right. And so it's important to, ask the right questions. What do you got? What's on paper? Right. Do you have any policy for it? Anything where you die naturally. Those are the starting questions we want to have. Ray, feel free to just unmute. The way our screen is set up, we can't see the text. It's so small. Is it a good way to...
Brush? Can you see it? You got some young eyes.
Get into the mic. Yes, please.
Yeah, Ray, just unmute.
Yeah. So what I was going to say is it a good way to tell the difference between PMI and mortgage insurance, like life insurance that covers your mortgage, is who owns the home after you pass. Like if it's PMI, then the bank is going to own the home that your family lives in. But if you have life insurance that can help your family pay off that mortgage, your family keeps the home they live in.
Right. So
good point.
Good conversation right there. Who owns it? Okay.
Yeah, that's another way to kind of discover the distinction between whether it's PMI or whether it's something that they actually took out themselves. You should ask the client, who'd you name as a beneficiary? Because the thing is, they would have to make that clear to the client during the application process. If they didn't name anybody, that means it's going to the mortgage company or to the bank.
Right. And then let's go into that part. So let's say we don't have a mortgage protection. If you guys enjoy, I'm saying it too many times.
Thanks for joining us so far. That's all I remember.
We can continue to share with other people. We probably need to redo it, right? Hey guys, thanks for joining us. If you guys have found this stuff helpful up to this point, or you guys would like to see some other stuff,
please like and subscribe and create a comment so we can cover that next topic.
And continue watching the show.
what typically would happen if it's a husband and wife that owns the house, let's say only one of the persons are on the house title or the deed, or they only got the loan off of one individual, the spouse and kids live there. How's the housing situation when the primary passes away?
Then the bank owns it again, right?
Right.
So it goes back. So the thing is, if you're going through the bank or the mortgage company, and then you get some insurance through there, the thing is they're not looking to protect the client to make sure that they still have a home to live in
right
after the fact. They're insuring the life of the client to make sure that they get their money back.
Mm-hmm.
Right. So that they're expected money or percentage of the money. I'm not sure exactly how they structure that insurance contract, but they're not looking out for the client. So if the client thinks, oh yeah, I think we signed this thing for insurance when we took out the mortgage, then the thing is, you should ask these follow-up questions like, would you name your beneficiary? How much do you pay a month for that? What company is that through? So if you don't make that distinction, then they're probably operating under a false pretense in which they're not going to be protected for what they expect. And then, this really doesn't serve the client. So at the very least, our goal in that situation, even if we can't help them with the insurance, is just to educate them and kind of put them in a better position to know how they can protect their stuff.
Yeah. And then I'm going into that part too. It's like, if there's only one person on the loan, the bank only has a contract with that one person.
Right.
And if that person dies, it doesn't matter if the kids are living in the house. It doesn't matter if there's other family members. They're not on the loan. They're not on the title.
Right.
Technically, the bank owns the house. So what they'll have to do is they'll tell them, okay, well, you get first dibs if you'd like to go and refinance for this, and then so you can make the payments. They don't just automatically continue to make payments. Right. So if the individuals cannot, let's say it's a stay-at-home mom, well, she doesn't have enough credit or she doesn't have a working job to reapply and get a new loan, they'll lose that house. Right. And
the bank or the mortgage company, they're going to take that property back, put it back on the market. They've collected the money that they got from you, from how much you put down and how much you paid,
plus the equity
costs, all the other stuff, equity.
Yeah.
So for the client that genuinely wants to protect their family against that, this is a good start for us to be able to help them, at least get them thinking and having that conversation, and at least take care of the part that we can help them take care of.
Right. Yeah. Same thing that happens too. We see a lot of stories where, going back to people relying on the work insurance. What if they have a lot of life insurance at work? Well, what if they get sick? So if they get sick, now they can't go to work. Well, if they're not working, they're not making income. Well, who's making the house payments? So now, besides of planning out a funeral in the future, now you're stuck in a bad situation where you might lose health insurance, you might lose your job, you might lose your house, and you still got to pay for a funeral. And so it's an importance of us being able to educate the client and identify the future problems that can happen without our products and services.
And, kind of help them either maintain a similar type of lifestyle as they were accustomed to before their loved one passed away, or at the very least, give them some time to be able to give them a cushion financially for them to figure out how to move on with the next steps, how to make those adjustments accordingly, because things will definitely change.
Yeah. So a lot of good conversations to have, especially for homeowners that you do know, aside from the leads that we have, right? But speaking of the leads, let's talk about the leads. Where can you get a mortgage protection lead?
We get this question a lot.
Yeah.
You get this too from agents, right?
Oh yeah. Well, I get that agents are interested in mortgage protection leads because they have a conception that like it's a better quality lead in a sense, right?
Yeah.
So
well, I remember when I first started, I just want to say this. When I first started, everyone was talking about, mortgage protection is great. It's like shooting fish in a barrel. It's like, it's so easy. And so I'm like, okay, well, that sounds like a pretty promising thing. I'm like, they said closing ratio is higher. They said premiums are higher.
Yeah.
All that stuff. And then for me, I was like, okay, that sounds really good. Then I tried some, and then, yeah, I mean, maybe the premiums were a little bit higher because I think people place a little bit more value on physical material goods more than their own life after they pass. They don't want to think about that part. Mm-hmm. So talking about your funeral, paying for a funeral, all that stuff, people, unless they don't want to leave that burden for their family, they have that concept in their mind. They're not thinking about like, oh, how nice my funeral will be. How much money can I leave them? So there might be a little bit of that, but I think the way I looked at it was with mortgage protection, there's a lot of fluctuations in the market. So like, I don't think it was very scalable type of business for me to just focus on that because there's only a finite number of property available, right? So if people are not refinancing, people are not buying homes, the number of leads significantly goes down.
Yeah.
Whereas final expense, there's always going to be people dying.
Yeah.
So that's what I pursued when I first started.
Well, for me, yeah, the variables for a brand new agent is just a lot compared to a final expense product or a final expense client. It's very simple when you work a final expense lead. And this is why we always tell new agents to just start off with final expense. You're just calling them to take care of either their burial or cremation. All you need is their age, their health. Those two criterias, maybe some bank account information or their budget to get them the range. With the mortgage protection, we have to assess a lot of things. Okay, what would happen to you if you died? What would happen to the spouse? What's the variable? Okay, well, how long did they just take out the mortgage? Do they have to renovate too? Now they don't have the discretionary income. What's happening here in America right now? All the interest rates are like 67%. At 7% plus the housing valuation is super high. Us living in California, it's an average 3-bedroom, 2-bath now at $800,000. So they get a 7% interest on an $800,000. They're paying $45,000 a month. Now we assess their budget. They're like right there. And we got to sell them an $800,000 mortgage plan, which is going to be really, really high. So it's a lot of variables. And that's not even including their age and their health. Now you got older clients, just got a new mortgage or a HELOC or a refi. And then
or reverse mortgage, we can get a lot of those from the seniors, right?
Right. And then you're like, dude, you owe 800,000, you're 60 and you had a heart attack. As the agent, I'm all like, what do I show you? How do I show you $1 million coverage where you don't qualify? Right. I just had this conversation with a client. I mentioned it to you guys. This guy was a lawyer, and he mentioned that he was a lawyer 5 times. It's like, John, I'm a lawyer. Okay, I just want the nitty and gritty, and I got a term policy. I'm 74. I'm turning 75 at the end of the year, and it's expiring. So I want to get another term, maybe like a 10-year term, to cover my $800,000 coverage. My health is good. I just had a bypass this year, early in January. So anyways, I'm a lawyer. I just want you to email me the quotes, and I'll get back to you. I'm looking at this, man. I just spent money on this dead lead. This is a dead lead, right? What can you show them? So would you have a lot of frustrations compared to a final expense? Would you have to rack your brain around trying to find a company, a carrier to find a product for somebody? Then you show it to them, they tell you, yeah, that's like $1,000 a month. That's an extra mortgage on top of my mortgage payment. It's less likely to happen, right?
Which, by the way, what do you think he kept saying he was a lawyer?
Arrogant.
I think partially it was arrogance, but also I think maybe he was just very insecure that he thought maybe we were going to give him, trying to give him the runaround or trying to juice him a little bit more than normal. I think he thinks, first of all, he thinks we care.
Yeah.
So it's like, oh, let me just tell him I'm an attorney, and then this way, he's going to be like minding his P's and Q's. He's not going to try to rip me off. I think that's what he was projecting.
Yeah, I kind of agree with.
Yeah. I'm all like, in my end,
I think once is enough to express what you do, like 4 times.
The best is like when you have like clients be like, oh yeah, all my buddies are cops, by the way, and I'm like, cool. What do you want me to do with that data? So I get it. I'm not going to try to rip you off. You got my license number. Just trying to help you out, buddy.
You can't help them all, but you got to look at it from a lead perspective. What's an average cost of a mortgage protection lead?
Yeah, so that's the thing about mortgage leads. They're a little bit more prohibitive also in the fact that, number one, they're not as abundant based off of market conditions. Mm-hmm. Also, they're more expensive to start off with, and they also require a bigger commitment. So they're more expensive because when people say like, oh, it's typically a bigger premium, higher closing ratio, which that's debatable. Mm-hmm. Premium part, maybe I agree with, but I think as far as average size, but the average cost of a mortgage protection lead is double, triple, maybe that of a final expense, sometimes more, quadruple.
Yeah. At the bare minimum, you're looking at $35 to $40 a lead. And usually that's an online type where they either market it online, mailed something, and they want something off of a postcard or a response online. Yeah. But if what's called a direct mailer, you pay for a lead marketing company, a vendor. They mail it out. whatever comes back, they charge you. That's called a buy per lead. That's usually $80 to $100 per lead. Right. So you got to understand, if you spent $80 to $100, you get 10 mortgage protection leads for $1,000. Whereas if you buy, internet leads for $11, how much more at bats do you have?
Right.
So it's a hit and miss. If you're really great at it, we have people that just work nothing but mortgage. They have a strong belief in it and they're doing great. Yeah, you will dial less. You're going to dial the same people. You might have a higher pickup rate, but you got to understand how to close those deals because you have such a small amount of quantity to close to make your money back before you're in a negative and deficit.
And by no means am I saying mortgage protection is not good. I think it's a great product. It's a great lead, but it's not for everybody. And you got to understand what you're getting into. I mean, I'll say this: when I first started, I spent $1,800 on leads.
Yeah,
I got mortgage leads, and so they were like $70-$80 a pop.
Right, and that was back in the days.
Yeah, it was back in the day. I got some old ones too, but I bought some $70-$80 leads. And the thing is, as a new agent, you don't know what to expect yet. So you're just thinking, all right, so I have 100 leads. I'm going to book 100 appointments and make 100 sales. Right? It's not true, but irrationally, this is what's running through your head.
Uh-huh.
And then the thing is, as I'm calling through them, they're like $70-$80 a pop. Already took care of it. Not interested, whatever. And I'm like, $70. And then the next one, they're like, not interested anymore. I can't afford anything, whatever their thing was. And, I tried to overcome it, try to rebut it a few times, but still couldn't get it. I'm like, $140 down the drain. So I started doing this reverse countdown, and it's way more painful.
Yeah.
Than if you start off with some cheaper leads, just to cut your teeth, just to get some experience. So I mean, I would definitely not advise. And this is the thing, I came from 11 years of experience in sales and insurance, so it wasn't really as big of a deal. I knew the numbers would work, but then it was still painful to start off. Yeah. So psychologically, it can kind of take you out of the game if you decide you want to go that route. But look, if you're more bold than that and you know exactly what your risk tolerance is, and you're gonna man up and just be like, whatever, I don't care what happens. I recognize the numbers. By all means, I'm not saying don't do it, but if you're still trying to figure out your footing in this whole industry or into sales, start off with something else first. Work your way up to it.
Yeah. So by working up to it, you'd want to master final expense, and then you want to add mortgage protection to it. The easier way to get mortgage protection is to buy mortgage protection aged leads, and that's on the Internet Life. The Integrity Lead Center on the ILC. Yep. You can buy aged leads. It's called 1 month or 3 month aged mortgage protection leads. Essentially, what happens is they've already filled out a form. They were either contacted or not contacted, or they weren't ready at that time. Sometimes on fresh leads, they just got the house that they haven't even made the first payment. So they're scared to make additional payments on anything. So 1 month old age leads are great about that, because now they've kind of gotten accustomed to payments. A month to 2 months in, they've already done the renovation, if they've done any renovation, and they know their budgets now. And so you come and meet with these clients, and it's just like another new presentation. But the difference is an aged mortgage protection lead will cost you about $7 or $9 a lead instead of $775 or $100. And there's plenty of those in the ILC. Even better, if you have multiple states, try going outside of California, because there are mortgage protection clients with only $100,000 in their mortgage, $200,000 compared to here at $800,000. So you have a lot more flexibility with products, whether it's a whole life or a term life or a return to premium cashback option.
The thing to understand about age mortgage leads too is just that it's been in someone's hands before, at least one person's hands. So the thing is, someone else potentially could have worked it. We don't know how well they did. I always assume for an age lead, it's not necessarily a bad lead, because you could always assume the previous agent didn't work it very hard, or they sucked.
Yeah.
Right. It's still an opportunity, because the thing is, even if the client had been contacted by the agent, maybe they helped them with something, but they left money on the table. Maybe they only didn't cover the spouse. Maybe they didn't cover the kids. Maybe their insurance needs have changed. I mean, there's still always opportunity. And, obviously, I hope this goes without saying, if you contact an age lead from another FFL agent, show them the courtesy, don't go and replace their policy. Yeah.
Switch it.
I mean, if they're an FFL agent, if they're not, I'd say fair game, but try to put them into a better position if you're going to replace the policy, because it's like don't go and replace the policy for something that's more expensive but less coverage, or it doesn't materially make that client's insurance situation better. Because if you do that, you're also subject to potential replacement rules within your respective department of insurance. So it's got to materially put them in a better place, because you're resetting that 2-year contestability period every time you cancel out a previous policy to write a new one.
Yeah. But I have great experience with age mortgage protection leads. One of my best sales, highest income, is from an age mortgage protection lead. I did a 1 month lead off the ILC. I met with the client. I sold the husband and wife. They're fairly old, and it was more of a critical period coverage. And we're going to go over that in a second. It was 3 families helped. And within about 1 to 2 years, the husband passed away, and the husband had an annuity that we were able to convert for the wife and switch that over. So I got annuity leads out of that. Most of my annuity sales have been from mortgage protections. Okay. Instead of final expense, sometimes the final expense, they don't have, they're limited on their income. They're on disability. When you're dealing with mortgage protection clients, they've had jobs, they paid on the mortgage, and sometimes they have retirement accounts. So I've sold 3 to 4 from annuity leads from mortgage protection. So I've doubled up.
Yeah. I mean, it's not always the case, but I think a mortgage protection client, that demo might be, they might fall into a certain category a little bit differently than just people that rent.
Right. Because middle income to higher income.
Well, there's that. I mean, some people deliberately choose to rent because they don't want to be stuck with that liability of owning a home. But I think for a lot of people that have a mortgage that bought a house, they got to plan a little bit more because they have a bigger responsibility. So they start planning out the retirement. They might have money in an IRA. They probably have 401k. They might have, whatever retirement, vehicles that opens you up to the opportunity of doing an annuity rollover. Mm-hmm. So begs the question we got to ask.
Yeah. You still got to ask, you will find some clients renting with 401ks, IRAs, but you will run into a lot more people saying, okay, do you have anything else to cover your mortgage? Like life insurance, 401k, IRA stocks. You'll run into a lot more people with that.
Right.
Yeah. So it's great because you will hit like big home runs sometimes. And that's nice. You're like, wow, this lead was $3 and I got paid like 5 figures. Right. Not a bad thing. Not a bad deal. Right. So what is a critical period coverage? So let's start off with
what it is.
With clients. What's the average age of a mortgage owner?
I mean, I guess probably in their 30s to
30s and up, right?
Yeah.
So the best clients, man, they're 30s, 40s, no medical issues, easy lay down. Like they have income, they have disposable income. And my youngest client was like 27 in Fresno. He had a $200,000 mortgage. So I showed him 200,000 cash back America CBO. It was like $135. No brainer. He'll pay off his mortgage in like 20 years. He'll get his money back. That's it. No complications. And then you get the clients, they're in their 50s, 60s, 70s. You got a client that just did a VA loan and they owe $4,000 a month on the mortgage for $500,000, and they've had multiple heart conditions. What do you do?
Yeah, so that's a pretty common thing. That also another reason why I say people should start with final expense first. Get some experience, make some money. Start cash flowing your business first. Then if you have the disposable income or the additional capital for you to be able to reinvest back into mortgage protection leads in addition to all your normal stuff. I mean, I wouldn't bank solely on just mortgage protection because I think it becomes very costly for one. You might not get the initial return on investment that you expect. And if you start needing money, you start running low on cash flow, then it could hurt your business significantly.
Yeah.
But I think the biggest thing as we talked about, there's some unforeseen challenges when it comes to underwriting or qualifying a client for someone that needs a mortgage protection, coverage, because they could be older. So number one, their premiums could be extremely high to cover the full mortgage with a term, or a lot of our clients, or not a lot of them, but some of them, they might have health conditions. They might have certain things that might be knockouts for them to be able to qualify for a term policy. So in that case, we got to pivot. And we got to use a whole life policy, that has a little more lenient underwriting, and then we'll be able to cover them for a small portion of what the actual full mortgage is. Now, the reason why this still makes sense to the client, because if they have a $800,000 mortgage and then they're not healthy, maybe they've had a stroke, at some point, or they have diabetes that disqualifies them from being able to qualify for a term. What we would do at that point, then we would have to pivot and just be like, okay, here's what we can do instead. Let's get you a whole life policy for $40,000, $50,000, $30,000, whatever their budget is. And we'll say, okay, this won't cover the mortgage, but this will cover X amount of mortgage payments to keep the family in the house for the next X amount of months or the next 2-3 years or whatever it is. So your family can make the adjustments and then they can figure out what they want to do with that house. Because the thing is, we had a friend, she was a motivated seller, and that it was a nice house, it was worth a lot of money. At the time, I think it was still a buyer's market, but it still took like over a year for it to sell, right? So the thing is, when people say like, hey, you still should get this coverage in place, even if you can't qualify for the term. Sometimes clients are like, the kids will just sell the house. And then it's like, that's a novel concept. That'd be nice in an ideal situation. But the reality is you never know how quickly you can sell the house, or you can sell it, but short sell it and get very little value back on it.
Take a low, get lowballed
right
in your prices.
Right. So, you can sell them on that concept. This is what we call the critical period coverage or the critical time period. So they say, we can't cover you for the full amount, but we can cover you during that critical period in your family's life after your passing. So they can make the adjustments. They can still stay in the home. They can make the mortgage payments in the meantime. They might miss time from work. They might have to take some time off to be able to get the house ready to sell, whatever it may be. It buys them time. Right. That's the critical period of the critical time.
Yeah. So the concept is selling it by logic, because at the end of the day, you can't sell them the full value or the full loan of the mortgage at their age, at their health, right? So what's the next best thing? So I try to make it simple for the client. It's a payment protector in a sense. And it's a time that helps transition you passing away and then your beneficiaries, your family members, your kids on what they're going to do with the house. Okay. So I give them the 3 main options. Before I even present it, I build the problem. I go and ask him, okay, so what's it look like, Albert, if you die tomorrow, what's going to happen in the house? Are the kids going to move in? Are they going to sell it? Or do you want your spouse to keep it? And then they'll usually give me an answer. Okay, if they're going to keep it, how are they going to make payments? Okay. Sometimes the spouse will be like, yeah, I get a portion, half of his Social Security. I get this, maybe I'll get by. Okay. Would it be better for you to sell it and maybe get the equity out and go somewhere else? So I'm leaning them to the logical side. So this is the critical period coverage. We'll take care of 6 months payments. So it's a simple process of, let's say they're making $2,000 a month, multiply it by 6, that's $12,000. That's the first option, 6-month payment. Second one is 12 months of the payment. And then third option would be 18 months of the payments, if it can still qualify based on their mortgage protection, which in some whole life policies, for example, Mutual of Omaha, they just went up to 50K. And it's up to 50K. America's up to 40K. So it's up there. So you give them these 3 options and you tell them, look, this is going to buy them time. If your kid, for example, if they want to move into your house, they might be renting right now. They might still be stuck on the lease for their rent, and they can't break the lease and make payments on this. Well, we have a mortgage payment on this. They can keep that. They can get rid of that, or they have the time to renovate it, fix it up, a little bit of life insurance to cover new painting, or they want to sell the house. It's going to give you time. It's going to buy them time when you pass on without having to worry about making payments on the house.
Right. Yeah. One other thing you want to drill down on too, because sometimes for the client, they might just think, I was going to buy them some time, then they're going to live in there for a while, and then what if they sell it anyway? So the thing is, you got to make them think about the money and time that they put into getting and acquiring this house.
Right.
Right. So then just be like, so how much, when you bought the house, how much was it worth? Has it gone up in value? Which it's land. It's going to go up in value.
All of them did. Yeah.
Mhm.
Right. So then just be like, what do you think it's currently appraised at now? Right. So then they'll give you an estimate and just be like, all right, well, here's the thing. Like, you're going to take out this policy so that your family can have some time to make their decision. Even if they say they're going to sell it, they're 100% sure their kids are going to sell it. Say, great, perfect. So all the work and time that you put into getting this house and building it up to this value, the thing is, it's gone up in value this much. So when you actually sell it, that's how much your family's going to receive. So this amount of money you're buying is actually buying them the $850,000 or $870,000 or whatever it is. So then you're kind of really painting the picture out for them and walking them through the whole process. And you're selling them on the value of what the sale of the house is going to be.
Right. The equity.
Yeah. The equity and then plus whatever profit. And this way, that seems like a much bigger value than just 30,000 in coverage.
Yeah.
Right.
Yeah. So it's a lenient underwriting in the end. They get protected. Something happens. I've had a sale with I had a client in Lakewood. He was like 80. And I remember him because it was like the last day or the last 2 days of America having the countdown to the bonus, the 6-month bonus. I remember it's like, hey, you got to hit your America bonus. And this guy's 80. He has a new house, but he didn't buy the house for himself. He bought it for his nephew or niece. And he was in the Navy, so he was a veteran. So he got a 0 down payment on the mortgage. He filled it out. I said, look, you did a great thing. Here's what we're going to do. We're going to give you a 6 months worth of your mortgage protection. In case something happens, they got an additional 6 months to pay on the mortgage. He said, okay, that makes sense. And, you're getting Social Security. You got your Navy retirement. It's going to pay for itself either way. Got me a bonus. Helped out. But imagine trying to sell an 80-year-old for a brand new mortgage he just bought that he didn't put a down payment on.
Right. Which is why it's vitally important in your sales process to ask a lot of questions, see what they value the most, and then keep pushing that hot button. Because the thing is, if you're just saying like they're expecting to get an $800,000 insurance policy to pay off the entire home, but they don't qualify, or it's out of their budget, or they don't qualify for the term because of their age, whatever it may be. If it's not practical, you got to find another solution and just be to counter offer by saying, all right, here's a critical period coverage for 40,000. I mean, it seems very unappealing if you just put it that way.
Right.
But if you say like, no, what's your family going to do with it? They're like, I'm sure they're going to sell it. Say, you want to make sure that they get the full equity. Isn't this what you work so hard for? For them to be able to get paid the 850,000 or 900,000, maybe it's over $1 million at that point when they sell it.
Yeah.
Isn't that really what they're getting? That's the value you're getting.
Yeah. So I think at the end of it all, it's a different type of closing. Would you agree?
Oh, 100%.
Yeah. Cause like for final expense, you could probably just close just on emotional sale. It's like, look, you don't have this. Who's going to bury you? You don't have this. Who's going to end up shelling out of their back pocket? And then you would let them go. If you don't sell logically, how do you sell emotionally when, it's like, I still got the house, right? So I could wait next month. What changes?
And that's the reason why it's a little bit more complex with mortgage. Because if they're young and healthy, you can sell them a term to cover all their premiums or to cover all their future mortgage. Simple, straightforward. No problems with that.
Yeah.
But if it doesn't fall into that neat little category, then you got to go next level thinking. You got to create several steps.
Yep.
Which is why you got to be a little bit more seasoned, or unless you're a super fast learner and you're super slick, which I don't know, even if you are, I mean, it's still going to take a little bit of time and experience for you to master it. So
yeah,
I will kind of work my way up to it. My personal.
But if you do want to tackle it, I mean, we're here for help. The easiest thing is just like a final expense is learn how to dial, right? You learn how to book the appointment and if you're doing mortgage protection, it's fairly new for you. On your appointment setting, start asking the medical questions and a little bit of financial information before you get to the appointment.
Right.
So you can contact your upline, ask a supervisor for help, and then we would already have a little bit of a game plan. So I'm a new agent. I booked an appointment with Joanne. I would ask Albert, okay, Albert, I got Joanne tomorrow at 3 p.m. And so far, this is what she told me. She owes this much on the house. It's just her. She does have a heart condition. We don't know what it is. This is the medication for it, though. So we would already have a little bit of a game plan to say, okay, you're going to sell her a CBO or you're going to sell her a whole life. So at least you wouldn't be blindsided at the end. Yeah. That would be the easiest way for us to help you. Right. Any other questions on mortgage? I know we went through a lot, but we want to just go encompass everything of what it does. It's a great tool. It's an additional product. It's additional clientele that you can reach within the working class. And aside from leads, we have a lot of people that we know that owns homes. Yeah. So how do you spark a conversation about that? It's like, you got anything going on with your house? So what would happen to you if you pass away? You got a brand new house. What about the kids? Do they want to live in it? Is this an inheritance? Are you willing to lose it? So.
Yeah, I mean, I was actually just talking to one of my buddies who's just got into the insurance industry, and he's not with us yet.
Okay.
But he's coming.
Okay.
But just give me some time, But he was talking about, he has a lot of friends in real estate.
Yeah.
So they were talking, he's like, hey, is there a way where we can, if he refers me over clients, then is there a way that we can, we can capitalize off of that,
collaborate and stuff?
And then I was like, yeah, I think, well, the insurance regulations, Department of Insurance regulations, commissioners, they cap how much referral fee that you can give them, right?
Which is $25.
Yeah.
That's what I thought it was $25.
$25.
Which is like a
I was
bottle
like
of wine.
20,
Yeah, you can't rebate
A mid-level bottle of wine, But
for a few bottles of wine. $2 chunks all day.
Get a couple 12 packs of PBR. But no, I was like, so yeah, there's a maximum limit that you can give for a referral fee. But I'm like, here's the long-term play. I mean, if he's going to have a lot of referrals, then why don't we get him licensed, and then you can just make him an agent. He can write the policies himself and get paid the most.
Or even better, if he could still refer it to you, you do the work, you do a split sale, and it's legal. If
he's licensed.
Yeah.
But then, so then the guy, I was telling him, he was just like, I don't know. He's like, I don't know if that guy really wants to work that hard. Like, that's always kind of been his thing. He just wants to just make passive income. I'm like, well, at the very least, just get him licensed, then we'll figure it out.
Yeah.
But I'm like, if he doesn't want to do any of that, then the thing is, you're a captain unless you go off the books. Yeah. Which I'm like, I'm not advising, because you're risking, you're jeopardizing your license.
When you go off the books, how do you deal with chargebacks? And that's the issue, right? Now you paid him something, and then now you want that back, and then you're still stuck on it. There are situations where I've seen it, man. People refer these clients, they got paid, but they got paid from that client too, and you paid them. It's a mess.
Yeah, I mean, there's definitely ways you can do it. I mean, we're all clever enough, but the thing is, I'm all about creating long-term win-wins, because I want to be able to keep it a productive relationship long-term where everybody wins, so everyone continues to want to do business together, rather than you can get over on your buddy, no problem, a couple of times, but then after they figure it out, they're like, I'm not doing business with you anymore.
But yeah, that's a good connection. If you guys have connections with people that are on real estate, they're great people to sell into the business, because they've already got a real estate license. They could double up. They just get their life license. And if they don't want to do the work, you do a little bit of the work.
Yeah. And just using some of the information that we kind of went over today. I mean, the thing is, when you have a friend that gets a house, or someone, just be like, hey, congratulations on your home. I'm not sure what you have for your coverage, but we have some coverages that'll be able to pay off the home in the event you pass away unexpectedly. So your family can still pay off the house, or continue staying there. So if you're interested, let me know.
How would you try to do that? Like, let's say you have a 1-minute segment on Instagram saying like, you should get a mortgage protection. What would be your post?
We got to conceptualize this.
Did you just get a new home? Well, you need mortgage protection, because if you die, the bank owns your house.
Yeah. Or something like, if you were to pass away and you own a home, how would your family make the mortgage payments?
Yeah.
Just be like, we have different solutions. And why don't we have policies that'll pay off your mortgage, and if you outlive your term, you could get all your money back.
Hey, there you go. Yeah, that's it. So it's plain and simple. Use your networking, use your social media. There's plenty of people that that owns a house, and there's plenty of people that too that they passed away and the house is in shambles. So there's a lot of people we could help. Any other questions before we wrap up?
Well, I was going to say my from a personal story, my uncle passed away. This is back when I was in high school.
Okay.
And then I don't think they had that much left on the mortgage to pay off. But then my aunt didn't want to make the rest of the payments. And then, we were considering, should we pick up the payments, and my mom was telling me, should we buy the house? And I'm like, do we even have the money to do that? And then they thought it was just gonna be a lot more. But then by the time like the mortgage payments were past due, then all of a sudden the banks repossessed the house. And then it turned out, foreclosed on the house. And then turned out that my mom found out afterwards it wasn't that much. So we could have just paid off the house and then.
But could you have paid it off like that if he was the only one, or was
I think my wife was on the.
Then she could have made a payment.
Yeah, but obviously insurance. I don't know the insurance situation. I don't want to speak on that, but it would have. If there was a clear insurance policy, then really easy to just pay off the rest and then sell the house and then get the value from that.
Yeah. And they probably would have had money left over from their mortgage protection plan since they owed so little.
Oh, for sure.
Yeah.
That's something we
should have they would have definitely won, because
that's something that's actually
not a portion of it and then
not touched on. But put it this way, you know, when you see a couple, sometimes there's only one out of the two that's really good with finances, right? And if that person passes away, the other person doesn't know what to do.
Yeah.
That could have been a situation for the aunt.
Right.
So that could be a conversation in the mortgage protection presentation. Who takes care of the finances? Okay, well, they won't know what to do. What's the game plan? Here's what we could do. I'm going to be your next backup.
Right.
Yeah.
Right. We're here for help. So,
Yeah, I was a high school kid at the time, so I was not insurance, obviously. So
you get your license.
I should have done it. I should have got a fake ID. I should have. No, but the thing is, yeah, I didn't have any practical experience to be able to even weigh in on that topic at the time. So I mean, that's the thing. I mean, if the more people we can educate now,
yeah,
if we can get this information out, so people can start like planning for it, even if it's not through us. If they're better prepared, I mean, I feel we've done something positive in this world.
That's true. That's true. Save homes, save lives, save a family. All right, guys. We'll see you guys next week.
Have a
you.
good
Go
one,
out there and
everyone.
protect people. Be elite and like and subscribe. Hey guys, thanks for watching. If you guys want to subscribe, click here. If you want to watch the next video, click here.